Hello, everybody. It is Monday, December 19th, 2022. The market is a little bit ambivalent after the options expiration from Friday. So we've had, I believe, 4 down days out of the last 5. Today is a little bit down so far, just not very much. The small caps and mid caps continue to take the brunt of the damage, with the large caps still not having caught up on the correction. I was reading some reports from 3 or 4 other research services over the weekend, and Tom Lee and I seem to be on about the same page here. Either the market's going to double bottom or it's going to set a new low before a big rally. And I'm not so sure that the entire first half of the year is going to be rough in 2023, but I do think you're going to get the earnings revisions in January and February during that earnings season. If we don't, then it just gets pushed out again. But most of the big research firms, your Morgan Stanleys of the world, are seeing earnings anywhere from rising 4% to shrinking, which is, pretty bearish. That would, at these stock price levels on the large caps, push the price to earnings ratio higher. So whether multiples contract at some point or earnings rise, you'd expect to see that come in one way or the other. Typically, the price to earnings ratio contracts to match the earnings expectations. One of the things that Tom Lee talked about, that I've talked to you about for a decade now, is that the demographics don't support a rising labor force anymore. So in the article that I'm releasing in January, which is titled Demographics and Robots Are Destiny, it talks about how we're going to have to deal with a coming era, which could last decades and decades, with less labor, is going to be marked by automation, which is driven by technology. So I've been telling you that when this correction is done, we're going to want to get into QQQ and technology. And we're probably within 10 to 15, maybe 10 to 20% of that happening. There's going to be other stocks in the S&P 500. And Tom Lee didn't use the word, I don't think. Maybe he did. But I've told you about the great divergence that's coming. And companies that don't offer growth, but have to rely on CapEx spending to make their widgets, are going to have problems. So certain industrial stocks could do really well on implementation of technology, but companies that don't do anything that's particularly high tech, they can't really benefit from technology. They just have to pay for inputs. They could have a problem, especially if they have high debts and low or no growth. And that's what we want to stay away from, which is between 100 and 200 stocks on the S&P 500. Now, there's a new service out there, and if you are a 7-figure investor, you might want to take a look at it, and that is the personalized indexing, basically building your own index. And that's a pretty interesting thing. The main benefit is peeling some of the stocks out of, say, the S&P 500 that you don't want to be invested in, but also the tax loss harvesting. So, if you don't have taxable investments, then it's probably not something that's for you. You stick with the ETFs. But if you have 7-figure accounts, especially hundreds of thousands or millions in stocks or ETFs that's taxable, then this personalized indexing might have some benefit for you. So we could talk about that if it makes sense, if you're not just managing your own stock portfolio. What else? I think that we are likely to see a Santa Claus rally and the January effect over the next 3, 4, 5 weeks. And that should be an opportunity to write covered calls or even trim certain investments, especially if, as you scaled in, you ended up with a little bit too much of it. So you might be able to sell one of your lots of stock because when you trade, you actually can designate a particular block of stock. So if you've scaled into a stock 3 or 4 times, like a lot of us have on certain things, you can say, well, it went up to a point where this block is even. You might want to sell that one to avoid taxation. It doesn't matter, obviously, if you're in an IRA, you just trim the amount of shares you want to trim and get it down to the right size for your asset allocation. So that's something to keep in mind if we do get a rally. If we don't get a rally, I talk about that down here, then that means that the correction is probably heading back down after this little rebound we've had since the middle of October, end of October. And we can expect a lot of the cash secured puts to become attractive. The prices will come to us. If we get the rally, though, I would expect to change a lot of the not the strike prices, excuse me. If we get the rally, though, I would expect to change a lot of the expiration dates from January to February to April. So we just have to keep an eye on that. An example would be, a stock where we have a January $10 cash secured put waiting to be sold for $1. And if the stock goes up in price, obviously the odds of that happening are pretty slim. Rather than changing the strike price, which you really don't want to do for fundamental reasons or even technical reasons on the longer term views, you just push your expiration out. So if it doesn't happen now, it might happen later. Just push the expiration out. The one thing I don't want you doing is chasing prices. When you scale in, you're trying to get lower prices by a double-digit amount. So if you buy something at 10, the next time you'd buy it would be 9 or 8. So if you write the $9 put, but you get $1 in premium, now all of a sudden you've bought at 10 and then a net cost of 8. So when you scale in, remember, keep it wide and slow, and it might take you over a year to get your full asset allocation. Make sure you watch the video from last week. I think it's important that you see how these charts work, comparing the monthly time frame to the weekly time frame to the daily time frame. So I've been updating this article today, and I have to go through it one more time. The one that I think you might want to take a look at today, or actually the two that you might want to take a look at today, are Enovix. The February $10 put for $1 is hitting right now. I had that execute in some accounts. You might be able to get more than $1 right now because it looks like the stock is down a little bit. And then Rocket Lab, I haven't sold this put yet, but I think this is what's coming, and it's close right now. But I took a starter position in Rocket Lab today. So it just goes along with the space theme. And I've been reading more and more about the potential market sizes for a lot of these different space-themed stocks. And the companies that launch rockets are going to do okay. But the companies that provide other services, like building the satellites for others, which Satellogic is doing, or handling a lot of the technology or repairs, monitoring the technology or making repairs and hardware updates, are going to make money over a longer period of time. So the combination of subscription services and technology upgrades is probably where the biggest money is going to be made on the space side. So as they provide the services, like the satellite companies, or they repair satellites, or they build satellites, or they upgrade satellites, that is probably another avenue of profits. The reason I'm not in love with the launch companies is eventually, and I think that's only 4 or 5 years out, I think there's less launches going on, which means that companies that are just focusing on launching are probably going to have some problems. And there's only a half a dozen of them, so it's not that big of a field to stay away from. One of the reasons why some of you might want to own Tesla is for SpaceX. But as I was right about Tesla coming down 50% in value from a year ago, I think that the valuation that's being assigned to SpaceX is just much too high. So I'm not positive that it's that important to own Tesla for the purpose of getting into SpaceX, because I think SpaceX would just come down 50 or 60 or 70% anyway. When you compare its market cap to the competitors, it's just way out of whack. It's like, why was Tesla worth 20 times more than Ford? That didn't make any sense. So for the same reason that I prefer these small and mid-cap companies, the flip side is I'm not a big fan of Tesla. And I don't think that they're going to end up being a runaway winner in EVs, like some others say. I don't think that their solar business is going to run away. And I don't think their energy management is going to run away. And I don't think that their space services or rocket launch capabilities are going to run away from everybody else. I think the field is closing on them in every business. There's big money and great technology. So I don't think you have to worry about chasing Tesla. If it comes back to you at some point where all the valuations make sense, then that's great. The one place that you might want to buy SpaceX is if you are an accredited investor, you can go into the private market and get a piece of it. I don't think that it's worth doing right now. Somebody mentions that Google owns a portion of SpaceX. Yeah, but at a much, much, much lower price tag. They were investing way earlier than we are. So we're 3 funding rounds in, something like that. 3 valuations in. Google invested when it was worth nothing, and now it's worth something. So I don't know that it's important to own it. Again, NFX triggered today. Take a look at it. I just started taking a starter position in Rocket Labs, and I will highlight that in the stocks of the week as I go through these. Some of these are older. I'm going to go through the REITs. I think the REITs are getting close, so we'll take a look at that. Permian Resources, I was going to finish with energy here. I think that energy will probably be a really good buy at the end of this large cap correction. I don't know that we get another shot at Occidental, but it's getting closer. New Fortress Energy, I would take another bite of that in the mid 30s or sell a put. I think their technology for providing natural gas to Europe is going to make them a fortune. The energy crisis in Europe is probably going to last 2 or 3 more years until they can make the necessary adjustments between alternative energy and getting more natural gas. What else? The ETFs, I did end up buying ARK. Where we go here? ARK FinTech. And today, for tax purposes, I sold out of the DAPP fund, replaced it with ARK FinTech. And then I ended up just selling all of the DAPP for uniformity. That probably means that today was the bottom. But like I said, I replaced it with the FinTech Innovation Fund. Square/Block and Coinbase are both top investments in the FinTech Innovation Fund, as they are with the digital transformation at Van Eck. And I'm basically substituting Shopify and Mercado Libre and a couple of other consumer and FinTech companies for a bunch of the crypto firms. I'm not sure if that's a great idea or not, but I am personally buying Bitcoin versus the mining companies and the other companies. People are talking about Silvergate, and I'll tell you what, they make a lot of their money through laundered money. So they're laundering money through South America and Southeast Asia and Eastern Europe. I'm not so sure that the company survives, but if they do, I've read that they get something like 70 or 80% of their income through laundering money for criminals. They deny that's what's going on, but it's clearly what's going on. And either they're going to get beat down really bad or they're going to go under. So that was like 4% or 3% of the Van Eck Vectors Digital Transformation. Canaan over in China, I wasn't so sure about. I just went through the list. And I was like, this 5th, 6th, 7th, 8th company, and 10th company, 12th company, 15th company, I just don't know about. So I was able to get the companies that I like through the ARK FinTech and then substitute more stable growth companies for the speculation in the crypto stocks. I knew that a crypto crash was coming. I said that a crypto crash was coming, and I still didn't think it would get this violent to the downside. But I think there's a better way to deploy my capital to maintain the upside without taking the downside risk. So if you're in DAP, you have to consider, do I hold on? Because in my head, I hate to sell a loser because maybe it'll come back. Or do you say, well, apples for apples, where can I reduce my risk and keep the upside? I think ARK FinTech Innovation is that investment. If you have speculative money and you just want to swing for the fences, then that's fine. You can use DAP, but it might go to $1. It can't go out of business, but they could close it, I guess, and return the money, like other ETFs have that have failed. But at this point, I think Van Eck is a strong company. I'm not worried about them. Would they close the fund? I doubt it. Would the fund go up in price at some point? I think at some point it does. I just don't know that we're going to get the regulations in crypto that we want to see now that the Republicans control the House. So we might be 3 or 4 years away from getting good crypto regulation because they might just fight for the next 2 years. So we'll see. All right. What else do we got here? I think that was about all I wanted to address today. I will get this updated this afternoon and out to you. I might wait till the closing of the market to see where everything's at. The stocks of the week is 3/4 of the way done. And then the review article I'll do after dinner tonight. Any questions? Yeah, I like PVW. It's down here somewhere. It was down here. Right there. PVW. Yeah. So if I can sell the $45 marches for $9, that gets me a net price of 36. Yeah, I think that is pretty darn close there. Yeah, it dropped again. It's down 4% today. Yeah, let me update this with new charts. See the March 40s, still not getting a ton of money for those. It's weird to me that those haven't gone up quite a bit today. Let me put in a test order for PVW real quick. Let's spoof the market. March. Okay, so the $40 March put, the 45. Well, I'm going to lower that to 40, I think. The 45 is going for about $6. The 40 is going for about $3. I guess you could do either one. Depends how bad you want to get into the stock. So we could do 40 for 4, 45 for 9. That'll get you into the same place, right? Net cost is 36. Just how badly do you want it put to you? If you really want it put to you, you do the higher strike price. If you're just trying to collect premium and whatnot, really just trying to collect premium, the lower strike price. You could even ask for a little bit more here. Let me go through these charts again, and I'll figure it out for you. What else? On Wednesday morning, I will be doing a webinar with Dale Pinkert over at Forex Analytics. That'll just be highlights because I don't have a whole hour of review and preview. And then on Thursday is the year-end review preview piece, which might actually go a full hour edited. I'll do a question and answer December 28th, is that? 29th? Whatever the last Thursday is, we'll just do Q&A. And then, back to the regular schedule. I wouldn't expect a stock and option show on the Monday following Christmas, right? The 26th, I wouldn't count on that because I think the market's closed. So if the market's closed, I won't do a program. Let's call it a day. It's sandwich time, and I will get these updated, but go slow. Take a look at your portfolios, mind your asset allocations. And for the several of you who constantly ask what to buy this week, the answer is the same as it is almost every week. Come back to the old articles and what I've updated and see where you are. Make sure you've broken your portfolio into slices. How much cash do you want to be holding? What do you want in your core? And what do you want as satellite? And then are you trading anything as well? If you're not thinking about your portfolio that way in slices, sleeves, right? In the hedge fund industry, they call it sleeves. You're not thinking about it the right way. You have to break things apart. Think of it like a pie chart. How much cash do I want to hold because the market is volatile? What are my core investments going to look like? What do I want in my satellite sleeve? These aren't here because you're supposed to own them all. These are just some of the higher potential investments that you can add. I won't end up owning 10 ETFs. I'll end up owning 6 or 7. And right now, EMQQ is my biggest holding. In my ETF portfolios, it's grown to 15%, 16%. With I can tell you right now, with a cost basis of $24.98. In my stock and option portfolios, my cost basis is a little bit higher, but I have puts that are going to expire. So my cost basis in my stock and option portfolios is $26.83, but I have about unless it drops below 28, I have $2 of premium coming to me. And if it gets put to me at 28, then net cost on that slice within the slice would be 26. So it'll probably bring me down to 26.40. Somebody asked, ASTS has also come down significantly. Well, did I not tell you that was going to happen? I told you that what would happen with ASTS is that people would get impatient, or the company would have to straighten out technical difficulties, which we knew would happen. But the latest statement about how they're dealing with, different telemetry issues makes it pretty clear to me that it's going to work. Now, how fast does it work? Don't know. And can they get a 1-year extension on their licensing? Yeah, probably. But that's a year more time than the competitors have to catch up. So somebody posted an article about ASTS today, and I played with their model that they had in the article. It's actually a pretty good little thing they set up. I don't know how accurate it is, but it's neat how they have the modeling for the finances. I find it hard to believe that AST Space Mobile doesn't go over $50 a share. And I almost find it hard to believe that they don't go over 100. Now, some of the people who are talking about 300, 400, 500, we'll see. We'll see. We'll see. I'm not so sure that they end up capturing 50% of that market. But given that they have a huge vested interest in Southeast Asia and Africa and the Middle East, and then with AT&T, I mean, that's potentially a lot of market share. 20 to 40%, I think, for sure. Half, hard to say. There'll end up being 3 or 4 competitors eventually. So we'll just have to see how that goes. But even if they only get to market 2 years ahead of everybody else and not 3, 4, or 5, that's still a pretty big first mover advantage. And if AT&T keeps making smart decisions, because clearly they were dumb when it came to Warner, but they seem to handle their core businesses very well. I think the fiber, 5G, and then with the satellite overage combination of services is just going to keep growing. And remember, AT&T has all that underwater cable. I don't think they'll ever sell it, but they have a lot of dark fiber, and that's rentable for sure. And maybe even they could sell some of it. So I think AT&T for a dividend payer, I think we've plumbed the bottoms on that one, and it's a good one just to hold on to pump dividends into your portfolio that you can spend on other stuff. I think AT&T heads to 30 for sure. Pretty sure that it heads to 40. And then if they end up becoming a global 5G carrier versus United States and our hemisphere, if they go global because of AST Space Mobile, AT&T could double in size or triple in size pretty easy, because people all over the world would love to use the AT&T network. You get American Tower to throw them on their towers around the world. Remember, American Tower is, very exposed to the emerging markets, which is why I prefer them to Crown. And AT&T has some hidden growth in there. So this whole triumvirate of AT&T and American Tower and AST Space Mobile, they play together very well. And their success is somewhat interdependent. AMT, though, I think is getting really cheap for the first time in a long time. So we might have a chance to triple our money on that little 5G basket. We'll see. And collect big dividends while we do it. Thoughts on Airbnb? I've thought Airbnb sucked forever. So, we'll see. I've never liked the company. I don't like the CEO. And I think that their business is highly disruptible. I think that they're going to get more and more competition and a lot more regulation. So, we'll see how that goes. One of the things I could tell you that I've learned about real estate in the last couple of years, but really the last several months in my discussions with these private equity firms and family offices that develop real estate, is that there's a lot more transition coming to commercial real estate. Companies like Airbnb, I don't know how they deal with condo complexes handling their own rentals. I don't know how they deal with tourist cities making it really hard to operate at Airbnb, like they've done in Las Vegas. So I don't know. I don't really like Airbnb, I guess is the that is the answer. Somebody says SpaceX and T-Mobile are using small satellites for 5G. No, they're not. They don't have it yet. They do not have satellite to cell phone 5G, and they won't for 4 or 5 years. So those small satellites do not accommodate the cell phones. It is scientifically challenging at best. You need a very big antenna to do it, right? Let's call it a day.